Good evening, everybody. Thanks for joining us again. This week, what I want to do is talk about intraday charting and look at how we can use charts and technical analysis from an hourly perspective, so much shorter term than perhaps we've looked at previously, and look at what actually takes precedence within technical analysis over this time period. Well, I think, to be honest, I think it's important to stress that all technical indicators that we look at within these webinars are viable and valid over every time period, whether you're a 15-minute trader out to an hourly, 4-hourly, daily, weekly, or even a long-term investor. They can all be applied in the same way. So I think when it comes to looking at activity within a short-term view, it's more a matter of what we need to be wary of within technical analysis from trading at a shorter-term perspective. And I think the first one perhaps may be a little bit of a surprise because it's an area that I put a lot of emphasis on, and that's candlestick patterns. I think from an intraday perspective, these vary because we're tending to look at the relationship between open and close with candlesticks and the various reversal patterns that form on the daily chart or even the weekly chart. Now, when it comes to an intraday 1-hourly chart, let's say, that relationship between the first opportunity to trade and the last is obviously negated because as soon as 1 hour period ends, the next one begins and the market continues to trade without any decision-making process that we may have within a daily chart or coming into the weekend for a weekly perspective. So we need to be aware that some of the reversal patterns are not as valid with intraday perspectives, and it's more a matter of looking at the lengthening shadows of candlesticks that reflect strong support or resistance at higher or lower levels that are and should be taken into account when we're building a trading strategy from a shorter term view. Also volatility. When we're trading from a shorter term perspective, obviously we're looking at a much shorter term outlook, and the volatility while can be a friend, can obviously also be a negative as well because we've got much tighter stops. So the increased volatility may well mean that we need to build that perspective within our trading size, within the risk that we're taking, and just build that within our risk management in general. I think you also need to establish what type of intraday trader you are, whether you're a high activity trader with a large number of trades but relatively low size. So you're actually doing a lot more trades during the day, trying to take less of a profit within each of those trades. Or if you're a low size trader, a low activity and high size. So you're taking a limited number of trades, but greater risk, greater size of your trade, to actually take into account that you can look for longer term price movements. You're not being necessarily as aggressive within your trading strategy, and you can build that into your actual time perspective. And if you go into any trade from a technical perspective or any perspective, to be honest, you have to go in with an idea of what you expect to see. So in other words, if you're starting to see positive trending conditions materialize, you're expecting that uptrend to be extended and to continue and to pay back you within that confidence of holding a long position within that trade. If that doesn't happen, if it doesn't develop as you expect to see, then don't ignore it. Because you're trading from a much shorter term perspective, then obviously this can see a shift much more quickly within directional risks. So any change within the chart activity, within the indicators you're using or within price, then it's telling you something. Don't ignore that signal. Don't get married to the position. Adjust your trading strategy to suit that new information. And be ready to change your view. If you're holding long positions all morning and you start to see negative views, then don't let that sway your opinion. If you're starting to see reversals and you need to change from being bullish to bearish within that daily perspective, then don't be afraid to do it. Because if the market's telling you that that's the directional change, you need to be aware of that. And then also, if you're not seeing any new signals being generated, then stand aside. Wait for them to materialize. no position is a position, because obviously if you're looking for the position, if you're looking for the trading opportunity, then you may well not be looking at things in the right perspective. So don't be worried about if you're sitting on the sidelines. Wait for the signs and the signals to develop to actually highlight what trade you should be doing, rather than you almost telling the market what you think it should be doing. So what I want to do is look at silver and price action effectively from June the 27th, and basically look at price action on an hourly basis. But it's important whenever you start trading, even on an intraday perspective, to look at the longer term time frame. So I will always look at the daily chart to get a feel for the general longer term trend and how that's relating to the shorter term perspectives. So I would start with the daily chart and really sort of see what is actually starting to happen. So you can basically, using Bollinger Bands, for instance, you can see we're in a downtrend. The average is falling. The bands are starting to widen. So we're starting to see negative volatility beginning to materialize for the daily perspective. And we've also broken lower from this consolidation pattern. So this is telling us that the longer term themes are more bearish for silver, because we've seen this downside break and the risk of negative volatility beginning to materialize, having broken lower. We would then look towards the 4-hourly chart just to sort of look at a shorter term perspective, but not necessarily yet within the time frame that we're looking to trade. So on a 4-hourly view, we would look at the market again from up to June the 27th. We can see that we're breaking below the 4-hourly mid-average, not necessarily an aggressive development, but certainly not standing in the way of that bearish daily view that we've already established. You can see on the 4-hourly chart that slow stochastics, the momentum indicator, is turning lower within what is still a bearish trend. The MACD is below zero. So effectively, we're still looking at negative themes beginning to develop and momentum turning down within that negative bias. So again, that can be a bearish signal and a trigger for lower levels on a 4-hourly perspective. So we've established that the daily view is bearish. We're breaking lower from a consolidation. There's nothing within the 4-hourly chart to suggest that we're wrong with that bearish view. So it's now that we would start to look at the 1-hour chart and see how the market is trading from that shorter term perspective. Well, again, this is the hourly price action up until the end of June the 27th. Now, obviously, if we're trading from a short-term perspective, we all have to sleep. So if we're trading from a UK base, for instance, this was the 11 p.m. close on June the 27th, and we probably wouldn't actually be active until 7 or even 8 o'clock the next day. So we would look at the price action from an hourly basis, having established the bearish themes within the daily and the 4-hourly perspective, and we would look for negative themes to materialize within the hourly view to re-establish that longer-term negative bias. So effectively, what we're doing is trading with the longer-term trend from a short-term perspective. So we'll wait new sell signals from the hourly chart, and that to highlight quite what is beginning to develop. So we have to wait a few hours later on in the day until we start to see more negative themes beginning to develop. We break below the declining mid-average, the bands themselves are beginning to widen, and we're starting to see a tagging of the lower band, which is a classic setup for Bollinger Bands for a more negative theme. So the hourly, 4-hourly, and daily perspectives are now aligned. And that's a much stronger backdrop to be looking for shorter term, more negative themes beginning to develop. We also have the MACD indicator, the trending indicator below zero, and momentum falling as well, backing up more negative themes. So we then start to see that negative bias beginning to establish as the market trades lower. Now, this is actually up until around about 10 p.m. London time on the 29th. So basically, we can actually see that the market has broken above the mid-average. So if we were trailing a stop behind this mid-average, then the risk is that we're starting to break higher and that would actually take us out of our short positions at a profit. But we would still be looking for more negative themes to reestablish themselves to then realign again with the daily and 4-hourly perspectives, because there's still nothing within this activity to suggest a bullish reversal. So we then start to look at price action beginning to materialize once more on an hourly perspective. We break below the declining mid-average. We then overnight start to see a consolidation. And as we re-enter the trading activity on the 31st of July, sorry, of 30th of June, we then start to see more negative themes developing in the morning London time as the bands start to widen, tagging the lower band, MACD below zero, and momentum falling. So we then move in a much more negative way, tagging that lower band within a bearish trend until we start to see the mid-average starting to be broken to the upside to stop us out, and just close the market having seen this more aggressive downside activity within price activity. So I think it's important to establish the longer term themes for a daily and 4-hourly perspective, even if you're trading from a much shorter term view. And when all three align, the daily, weekly, and what period you're trading in, they all align in the view, then basically that gives you the signal to enter a trade with more confidence that because all three are aligned, then the risk is that we can start to see more negative themes in the case of silver beginning to pan out, and we have more confidence within holding that negative view until we start to see the shorter term 1-hourly perspective beginning to turn towards a more extended consolidation, the mid-average on Bollinger Bands being broken to the upside, for instance. So by using the three, we can have more confidence within our shorter term trading and be aware of where the risks are developing, not only from a long, but also from a short-term view. So that's the technical look for this week. I'll be back in a couple of weeks' time. Thanks very much for listening.